Okay, folks, so worldwide markets are currently selling off, and we need to understand why. We discussed a week ago how the new U.S. economy is sending the globe into a spiral. How, by 2025, we might experience not only a currency crisis, but also a global asset meltdown. And it's critical that we understand how storm clouds arise. Trump's trade war is causing widespread worry, and it is not limited to China. In 2025, U.S. policies will have the greatest impact on G7 partners and their economy. The Federal Reserve has now indicated that interest rate decreases may come to an end this year. In a world where U.S. interest rates must fall, this means calamity. It is especially true for economies that are over-leveraged, overspending, or experiencing stagnant growth. And now the United Kingdom is the newest casualty. We are experiencing another low-trust period, with the true motor of today's economy collapsing, and this is dangerous since other G7 members and rising countries are following. Britain's bond market is practically imploding. Long-term borrowing costs in the United Kingdom reached their highest level since the 1990s. In other words, UK bond prices have fallen to a 25-year low, and investors have been burned. On the consumer level, yields have risen. If you have to borrow money to finance anything, you're basically screwed. The main problem Britain confronts is a breakdown of trust. When investors acquire bonds, they want the country's economy to expand so that they do not default. However, they also demand that government expenditure be managed so that the currency does not collapse. Well, the UK lacks all of those, and money is abandoning British assets. Government debt has reached its greatest level since the early 1960s. In fact, we're quickly nearing World War II levels. Debt to GDP is set to reach 100%. And unlike in the United States, the quantity of debt in the United Kingdom is far more significant. Demand for British bonds remains uncertain in the absence of US dollar support. The UK economy has practically stopped, productivity has fallen, and government investment has also declined. Let's not forget about the exodus of cheap Russian energy. All of these factors contribute to the decimation of British industry. Now, does this sound like a familiar theme? Is the EU tale repackaged for the UK? Investors dislike the future prospects. Through 2029, British growth will be lower than the G7 average. The Western Bloc as a whole will expand at roughly 1.8%, whereas the United Kingdom will increase at only 1%. In truth, all of these estimates are quite optimistic. In contrast, the United States will expand at a rate of more than 2% of GDP. Sure, its growth is driven by deficit spending, but investors understand that even debt is more sustainable than in the UK due to the currency and the US consumer market. So financial power, or money, is abandoning ship today. So if interest rates continue to rise, the UK's economic growth would suffer greatly. According to predictions, it will lower GDP growth this year by 0.3%. And for the markets, this is terrible news. It means the government will have to borrow and spend more, which could devalue the currency. Now, if British bonds yield 4%, but the pound falls by 4% or more, you will lose money. You could even lose money from the currency risk. There's another issue to consider. The percentage of UK foreign bond investors had increased to an unprecedented amount. In 2004, it was barely 15% of overall debt, and 20 years later, it is approximately 29%. These isn't local investors or British banks buying the bonds. These are foreign holders looking for a real return. And the lower the currency falls, the greater the desire to liquidate their bond holdings. They aren't faithful here. And what we're witnessing is a result of U.S. economic policies. As U.S. interest rates remain high and the currency appreciates, it serves as a wrecking ball for global debt markets. It does not discriminate. Money would move away from UK assets and toward US bonds. It's the classic safe haven trade, since no matter how insane things become, the US dollar remains the world's reserve currency. It is the baseline. However, this has far-reaching consequences for the United Kingdom and its people. This is where the story takes a tragic turn for the man on the street. Now, thanks to British bonds collapsing, mortgage rates in the UK could fly up to the moon in 2025. 700,000 borrowers will face higher monthly payments in the near future. This year alone, UK households will pay £1.2 billion to refinance their mortgages. The amount of bigger housing payments is starting to trend up once again. But what if rates continue to stay high? What if UK rates go further higher? That's going to demolish the middle class. What will you have left over at the end of the month if you have spent all of your money on mortgage payments? What Britain is facing is a rising dollar reducing liquidity. Rising bond rates in the US are driving money to migrate from global economies into the US. And that is really the system we are in. The domino effect extends beyond UK bonds. It has an impact on the pound sterling as well. If demand for British debt falls, so will the demand for the local currency. And that is why the pound has fallen back to its 2023 lows. In only 1 month, it has fallen 4% versus the dollar. The devastation has now extended to people on Main Street. Imports will cost more. Shopping at Harrods is more pricey. Buying food is going to be quite expensive. And this is the issue with the US currency system. When anything goes wrong, it affects everyone. And this will be a coordinated collapse, with the weakest economies first to be revealed. It's Friday, and the markets are plummeting hard. Now, we discussed yesterday how rising rates constitute a massive collapse risk, a threat to assets. 2024 was an unbeatable year for stocks. We all witnessed enormous profits. The S&P recovered well over 20% with ease. However, the story is going to alter in 2025, and we have to talk about how high U.S. bond yields can go. The 30-year yield has above 5%, while the 10-year yield has officially surpassed 4.7% and is on its way to 5%. The jobs data still indicates a very strong outlook. Over 250,000 jobs were created in December, and this gives the Federal Reserve additional protection. The argument for maintaining high interest rates remains. So the key issue is, how high can bond rates go? How long can they remain up there? Because if it continues for too long, it might push the globe into a recession. And of course, the markets would tumble much worse, especially given how high valuations are now. Now we only need to see how much money the Treasury will borrow. This quarter, from January to March, Yellen and her successor will borrow $823 billion. That is a tsunami of bonds hitting the market. So the supply of treasuries is increasing as the Federal Reserve refuses to lower interest rates. This is why bond yields are so high. The danger of global tariffs adds gasoline to the inflation fire. When Trump decides to smash the globe, a few things are almost certain to happen. The U.S. will suffer from a rising CPI. Prices on the shelves will rise. As a result, domestic inflation in America might worsen significantly. Second, the flow of funds into the world will slow. What happens now that the dollar is scarce? It boosts the dollar and devalues global currencies. Now, the entire world, from Asia to Europe, is suffering from increased import costs. Global inflation rises, and the stock market collapses. The current situation might worsen tremendously. When we look further into customer expectations, we notice a problem. Americans expect prices to rise much higher than previously. TPI will remain at 3.3% during the next 10 years, up 30 basis points. This is a significant challenge. The Federal Reserve's mission is to persuade folks like you and me that inflation is not an issue. In other words, they want people's expectations of inflation to decrease. In Powell's universe, everything appears like a nail. High borrowing rates, which serve as the hammer, are his sole remaining instrument. Now, the chances of a significant rate drop in 2025 are slim to none, and Slim has just departed the building. There's another major reason why stocks are selling down so violently. The U.S. economy is based on credit card spending. people swipe their plastic as if there's no tomorrow. However, if yearly interest rates remain high, defaults will increase and banks will begin to lend less. And that is already occurring. Outstanding credit card debt has decreased by about $14 billion, the greatest since the epidemic. People aren't spending anymore and banks are reluctant to lend. Why? Because credit cards have APRs of at least 22%. And when bond rates rise, it will likely remain at or rise above that level. As a result, we have a daily cocktail of events affecting both the global and U.S. economies. Nobody is immune to the upcoming train catastrophe. This playbook has been used repeatedly over the previous few decades. Every time the dollar rises, it triggers a worldwide currency and bond crisis. However, this is not healthy for the United States or its hegemony. It reminds nations to break free from the system. And this is why nations such as Indonesia are joining BRICS. They wish to rely less and less on the dollar system, instead trading in local currencies and borrowing more money outside of the USD. And it's no accident that BRICS is growing. What's worrying is that even the United Kingdom is turning to China for help. And, as we have already stated, the best way to lessen dependency on the United States is to increase trade with China. Rachel Reeves will meet with the Vice Premier in Beijing to forward her agenda. Russia, Taiwan, and Hong Kong are now on the list, but they are only sideshows, appetizers before the main entree. What the UK actually wants is more commerce with China, especially as the US begins to pull inward. And we may soon see the US importing less British goods. In addition, industries may depart Britain for the United States. Trump's tariffs might lead to a wave of deindustrialization in the United Kingdom. This is exactly what is occurring in Europe right now. And if BRICS does not address this, trends in the British bond market and the pound sterling may deteriorate much worse. China's trade with Britain has declined since 2021. Both imports and exports are down. The Chinese have other options, particularly nations and partners in the BRICS. So the UK will have a Herculean effort to reverse this, because the Chinese economy, at least in manufactured products, is self-sufficient. So it will be fascinating to see what Starmer's government has to offer. However, if they do not, the situation in Britain may deteriorate further by 2025. Beijing's investments must expand, as must exports to China. And now, let's take a step back and look at things holistically. Everyone can perceive the crisis's short-term impacts. Global currencies are falling, global bond markets are under pressure, and as U.S. rates continue to increase, the stock market is plummeting hard. Even Bank of America adjusted their projection. There will be no interest rate reductions in 2025. The job market is proving too resilient, and the Fed's reduction cycle has ended. So we must prepare for bad things in the next months. However, the long-term consequences are also pretty evident. More nations will be pushed to diversify their trade and economic relationships. As the United States decouples from the rest of the globe, the G7 will be forced to seek elsewhere. The only remaining choice is BRICS, notably China. So hold on tight, people. There's certainly more negative to come. Remember, the endgame remains inflationary, so don't over-leverage yourself and don't panic sell. But tell me what you think. Will increased interest rates destabilize the global markets? And which Western countries will follow suit with China? Please let me know in the comments below. Stay safe, like, and subscribe as we traverse these tumultuous times.